All right. All right. Testing 1, 2, 3. Testing 1, 2, 3. ECB. ECB. Good morning, everybody. I don't know. I just decided to do this. ECB. ECB. Hey, let me remind you that trading's risky, not appropriate for everyone. Hang on. Give you a better camera view. It's hard to see, huh? Anyways, outdoors. How you doing? Good morning. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonald. I will be your guide on this journey we call Forex. I do these live streams. I wrote a book. I run FX Bootcamp. And I represent TradersWay.com. All the links are in the description below. The book, Strategic and Tactical Forex Trading. FX Bootcamp, hardcore foreign exchange trading. 65 hours for $88. 65 hours of training for 88 bucks. Trader's Way, an ethical foreign exchange broker with a business model based on a symbiotic relationship with you. The only way they succeed is for you to succeed first. I love it. I love it. TradersWay.com, open up a demo account, see if they'll earn your loyalty and respect like they earned mine. The sound is low, really? It shouldn't be too low. Hang on, that screen I need to move over. There we go. It's not bad. Well, I think it's as good as it's going to get. How about that? Turn your speakers up. It's full blast, but you're right. It's not redlining. Unless... No? All right. No, this is the mic. All right. So cool. So what did the ECB do? Yeah. Good. Does it fix everything? I hope so. I hope it makes everything right as rain. Yeah, we're on early today because of the ECB. So what we're going to do is watch the press conference together and smoke cigars and drink coffee. Yeah. So we do it. I'm finishing up a Cohiba Dominicana, and I'm going to work over to a Cohiba Black. Cohiba Black, not a sponsor of today's program. Cool. Okay, so by the way, one of the reasons I'm streaming outside is I think I figured out all the problems that I've been having live streaming on my portable setup over the last couple of years. Remember how I tried different software, different settings, and I did research. I spent hours and hours and hours of research, tried different software, now I'm using a basic version of OBS Studio, but I typically use something else. But what would happen is I would stream, and after a few minutes, it would freeze. I think I figured it out. Do you know what it was? It was an indicator on my charts. Can you believe it? An indicator on my charts would freeze the streaming software. It was an indicator, not the software, not the settings, not the internet. Just like unbelievable. So I think we're good to go. I think this won't freeze, quote, fingers crossed. Although now that I'm looking at my chart, they look frozen, don't they? Oh my God, you're kidding me. Yeah, they are frozen, aren't they? Oh, there you go. I jinxed myself. Yeah, look at that. I jinxed myself. I should have known. Come on, Wayne. I jinxed myself. Yeah, they're frozen, aren't they? Ah, too bad. I thought I had it figured out. Oh no, it's so sad. Huh. Wow. So anyways, we'll watch the ECB press conference together. Yeah. Yeah. I wouldn't expect the market to be this quiet. Oh, too bad. I thought I had it figured out. It's not an indicator. Oh. All right, so my problems continue. Oh, hang on. How sad. Too bad, so sad. System interrupts very high. I don't know what that is. Yeah, too bad. With the lights out, it's less dangerous. Here we are now. Entertain us. I feel stupid and contagious. Okay. Okay, well, let's. Yeah, too bad. Ah, I thought I had it figured out. I was almost happy there for a second. Should have known better. Yeah. So, anyways, what I'll end up doing is we'll just stream the ECB conference. Well, what does work is it's amazing whatever is stalling. It's something on the trading platform. It's an indicator on here because I know I can shut down MT4 and stream just totally fine. So there's something on my MT4 that doesn't like streaming. Oh, there we go. Finally updated. That was a little slow, huh? Let's see. Let's just go to yens. Let's see if it can handle a request like that. Go to the yens. Well, it's certainly better than we've seen. Anyhow, Bank of Japan was trying to intervene verbally last night. Did you catch that? Thomas is in Zambia. How's the weather in Zambia today? Yeah, no action yet, which could be interesting information, couldn't it? Okay. What a great week it's been on the yens, though. Okay, I'm going to get rid of this one. I'm just going to get rid of it. I think with this much lag, less is more or less. Okay. So I'm going to have to throw on the ECB on a different screen. So I'm on my triple screen laptop. Because if you don't have 3 screens on your laptop, you suck. If you don't have 3 screens on your laptop, you suck. That's why. Oh, that's funny. I typed in ECB on YouTube and they brought up the English cricket board. That's funny. European Central Bank. How funny. Okay, these charts suck, huh? I gotta zoom in a little bit. There we go. European Central Bank. Yeah, that's the one I want. And of course, they don't have it scheduled, or what? There it is. Okay, I got it. So I'm going to drag that over to a different screen. Or actually, I'm going to pop the chat on the first one. How about that? All right, come on, YouTube, pop the chat. Pop chat. I feel stupid and contagious. Yeah. Hi. Cool. That's going to load. Open that up. Very nice. And then we got YouTube over there for our sound. Very nice. Are we close to capitulation? Well, when we're looking at some of these yen pairs, we are priced for capitulation. So in the day trading group, we talked about like I think Aussie yen was one of them. It might have been pound yen as well. That we're at the right price, and I'm not shocked in the least that hours, right? Hours, like, because when we hit our targets on the yen pairs, it was the middle of the night in Japan. So by the time Japan wakes up and they go to work and do their thing, the Bank of Japan sees we're at target, and the first thing they talk about is their YCC policy. The morning after we hit our monthly targets. And I'm like, dude, I don't think that's a coincidence. But what I also didn't see yet is a crash in the yens. Not yet. Pavel says, I thought maybe the ECB would raise by only 0.5. Yeah, I wouldn't have been shocked if it was even less than that. Yeah, so I thought I found the thing slowing it down. I'm really disappointed now. So these charts are just for color, folks. I'm watching the chat. So I have the broadcasting software on that screen. You see my central screen, and then the left screen is where I have the chat and the ECB live stream posted. All on my laptop sitting outside. It's cool, right? So bummer. It's a bummer that the charts froze. I really thought I got it fixed. So I got a plan B, of course. Yeah, I heard about the Queen. I don't know anything. I didn't get any details, but yeah, I don't know what to say. Okay, let's work on our plan B. Okay, let me open up my plan B. It opened 3 windows. All right. With the lights off, it's less dangerous. Here we are now. Entertain us. I feel stupid and contagious. Here we are now. Entertain us, yeah. Okay, here he is. Let me get rid of all the extra windows that opened. Don't need that. Don't need that. Cool. Tracking the smart money, yeah. I think the ECB meetings are just 5 minutes away. There's my neighbor's helicopter. Dude, seriously? All right. So this is the S&P 500 daily chart. You can see where we are riding at 21. Still quite a bit of risk off, even though yesterday you might have had a good day. That'd be great if it decided to change. On this time frame, it's a little more bullish than it has been for a while. Okay, but I have a feeling this has to do not only with the Bank of England and the ECB, but we also have a Fed meeting coming up. Okay, so people are jostling for position, risk on, risk off, good, bad. Oil prices were down sharply yesterday. It was quite an outlier. So as she is talking about the Commitment of Traders report, and I analyzed that on Monday. No, wait, what? Monday was a holiday. Well, Monday night, when the day trading group got together, we reviewed the Commitment of Traders report, and it wasn't just an increase in the risk off basket, because Ashish, I don't just look at the currencies. What we do is we gather assets together and create a basket, a risk on or risk off basket of trades, and then instead of looking at the individual assets, which I don't know, I want to look at things in context, not just what one asset class is doing, but what all asset classes in a trading strategy would do. If that makes sense, I think it does. And so when you look at the risk on and risk off basket, what happened is the risk off basket went up and the risk on basket went down. So even more informative, right, Ashish? Yeah. Now I'm going to build an application that will present that with with the longer term trends, not just month to month comparison. Hey, by the way, on the chip shortage side, as on the supply side challenges that the world's facing, one of the world's largest semiconductor manufacturers reported yesterday year-over-year sales growth of 60%, which means they're taking orders and fulfilling them. How cool is that? Up 60%. Now, last year would have been dismal because they didn't have any chips to sell. But hey, man, I'll take the good news. Because I'm sure I'm a huge purchaser of semiconductors. Not directly, but indirectly. Whoa. So anyways, we got some, well, in this case, a black candle, considered a red candle of the S&P 500, coming down into the hourly moving averages. So a bull is going to get ready to buy soon, and a bear already sold because they're attacking the 4,000 line, right? ECB is still not live. I'm sure we're just seconds away. So this is actually pretty a good view looking at the looking at the S&P 500, looking at we're facing a role reversal. We are obviously already at a bearish short. So bears can take over if they want to or if they do. But on the flip side, bulls are getting ready. And we got the ECB coming out, so you know they're going to react one way or the other. So it'd be interesting to see how the volume shakes out. Because you can, in this scenario that we're facing right this second, we could have an increase in volume of both the bulls and the bears. So think of the ECB. they're in a situation where normally you would be cutting interest rates. And yet they're raising interest rates, well, aggressively in the scenario of they haven't really raised interest rates at all. So now with 10% inflation and slowing growth, they're raising interest rates because of the inflation, but the slowing growth would make you cut interest rates. Also, Greece and Italy are in a much different scenario than France and Germany. Yeah, sure. Yeah, right, Susan. All right. Is ECB late or is YouTube frozen? Let me see. What's the time? It's time to get ill. Have I forgotten? What time is it supposed to start? I thought now. Are they late? Did I mess up? Was it 9? No, it's not 9. Oh, no, here they are. Yeah, they're on European time, huh? There we go.
Good afternoon and welcome to the ECB press conference. I'm joined here on stage by President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. As we are meeting in a hybrid format again, I would like to ask those who will then later ask questions via their camera to put on their microphones and their cameras because we want to steer and hear them. And now, give the floor to President Lagarde. President Lagarde, please.
Thank you very much, Wolfgang. And good afternoon to all of you, particularly those that I can see in the room. I hope you had a good break. So, today the Vice President and I welcome you to our press conference. The Governing Council today decided to raise the 3 key ECB interest rates by 75 basis points. This major step frontloads the transition from the prevailing highly accommodative level of policy rates towards levels that will ensure the timely return of inflation to our 2% medium-term target. Based on our current assessment, over the next several meetings, we expect to raise interest rates further to dampen demand and guard against the risk of a persistent upward shift in inflation expectations. We will regularly re-evaluate our policy path in light of incoming information and the evolving inflation outlook. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach. We took today's decision and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period. According to Eurostat's flash estimate, Inflation reached 9.5% in August. 9.5% in August. Soaring inflation and food prices, demand pressures in some sectors owing to the reopening of the economy, and supply bottlenecks are still driving up inflation. Price pressures have continued to strengthen and broaden across the economy, and inflation may rise further in the near term. As the current drivers of inflation fade over time, and the normalization of our monetary policy works its way through the economy and price setting, inflation will come down. Looking ahead, ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 22, 5.5% in 23, and 2.3% in 24. After a rebound in the first half of 22, recent data point to a substantial slowdown in euro area economic growth, with the economy.
So the key point here is that she's going to raise interest rates again.
First quarter of 23. Very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they are still constraining economic activity. In addition, the adverse geopolitical situation, especially Russia's unjustified aggression towards Ukraine, is weighing on the confidence of businesses and consumers. This outlook is reflected in the latest staff projections for economic growth, which have been revised down markedly for the remainder of the current year and throughout 23. Staff now expects the economy to grow by 3.1% in 22, 0.9% in 23, and 1.9% in 24. The lasting vulnerabilities caused by the pandemic still pose a risk to the smooth transmission of our monetary policy. The Governing Council will therefore continue applying flexibility in reinvesting redemptions coming due in the Pandemic Emergency Purchase Programme portfolio, with a view to countering risk to the transmission mechanism related to the pandemic. The decisions taken out today are set out in a press release available on our website. A separate technical press release on the remuneration of government deposits will be published at 3:45. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy grew by 0.8% in the second quarter of 22, mainly owing to strong consumer spending on contact-intensive services as a result of the lifting of pandemic-related restrictions. Over the summer, as people traveled more, countries with large tourism sectors benefited especially. At the same time, businesses suffered from high energy costs and continued supply bottlenecks, although the latter have been gradually easing. While buoyant tourism has been supporting economic growth during the third quarter, we expect the economy to slow down substantially over the remainder of this year. There are four main reasons behind this. First, high inflation is dampening spending and production throughout the economy. And these headwinds are reinforced by gas supply disruptions. Second, the strong rebound in demand for services that came with the reopening of the economy will lose steam in the coming months. Third,
time for that
the
Cohiba
weakening
Black.
in global demand, also in the context of tighter monetary policy in many major economies,
Made his favorite cigar.
and the worsening terms of trade will mean less support for the euro area economy. And fourth, uncertainty remains high and confidence is falling sharply. At the same time, the labour market has remained robust, supporting economic activity. Employment increased by more than 600,000 people in the second quarter of 2022, and the unemployment rate stood at a historical low of 6.6% in July. Total hours worked increased further by 0.6% in the second quarter of 22 and have surpassed their pre-pandemic levels.
Leathery,
Looking ahead, the
cocoa,
slowing economy is
unsweetened
likely
cocoa,
to lead to some increase in the unemployment rate.
coffee,
Fiscal support measures to cushion
black
the
tea.
impact of higher energy prices should be temporary and targeted at the most vulnerable households and firms to limit the risk of fueling inflationary pressures, to enhance the efficiency of public spending,
A little bit
and
of
to
dry
preserve debt
grass.
sustainability. Structural policies should aim at raising the euro area's growth potential and supporting its resilience. Inflation rose further to 9.1% in August. Energy price inflation remained extremely elevated at 38.3%,
Oh.
and it was again the dominant component of overall inflation. Market-based indicators suggest that in the near term, oil prices will moderate, while wholesale gas prices will stay extraordinarily high. Food price inflation also rose in August to 10.6%, partly reflecting higher input costs related to energy, disruptions of trade in food commodities, and adverse weather conditions. While supply bottlenecks have been easing, these continue to gradually feed through to consumer prices and are putting upward pressure on inflation, as is recovering demand in the services sector. The depreciation of the euro has also added to the build-up of inflationary pressures.
S&P 500 coming
Price
down,
pressures
lower
are
low on the
spreading
fiber.
across more and more sectors, in part owing to the impact of high energy costs across the whole economy. Accordingly, measures of underlying inflation remain at elevated levels, and the latest staff projections see inflation excluding food and energy reaching 3.9% in 22, 3.4% in 23, and 2.3% in 24. Resilient labour markets and some catch-up to compensate for higher inflation are likely to support growth in wages. At the same time, incoming data and recent wage agreements indicate that wage dynamics remain contained overall. Most measures of longer-term inflation expectations currently stand at around 2%, although recent above-target revisions to some indicators warrant continued monitoring. Let's turn to our risk assessment now. In the context of the slowing global economy, risks to growth are primarily on the downside, in particular in the near term. As reflected in the downside scenario in the staff projections, a long-lasting war in Ukraine remains a significant risk to growth, especially if firms and households faced rationing of energy supplies. In such a situation, confidence could deteriorate further and supply-side constraints could worsen again. Energy and food costs could also remain persistently higher than expected. A further deterioration in the global economic outlook could be an additional drag on euro area external demand.
By the way, I think natural gas prices in Europe are
The
going to
risks
drop
to the inflation outlook
hugely,
are
like
primarily
by
on the
50%
upside.
in
In the
8
same way
weeks.
as for growth, the major risk in the short term is a further disruption of energy supplies. Over the medium term, inflation may turn out to be higher than expected because of a persistent worsening of the production capacity of the euro area economy.
arbitrage when the liquid petroleum plant
a rise in
in the United States reopens.
Above our targets,
That's why.
or higher than anticipated wage rises. However, if energy costs were to decline or demand were to weaken over the medium term, it would lower pressures
You can't
on
see
prices.
it. The cigar is amazing.
Let's look at the financial and monetary conditions now. Market interest rates have increased in anticipation of further
That's right,
monetary
teams.
policy normalization
Sound zone.
in response to the inflation outlook.
But to contrast, that means
Credit
prices in the
terms
United
have
States
become
are going
more
to double.
expensive over recent months, and bank lending rates for households now stand at their highest levels in more than 5 years. In terms of volumes, bank lending to firms has so far remained strong, in part reflecting the need to finance high production costs and inventory building. Mortgage lending to households is moderating because of tightening credit standards, rising borrowing costs, and weak consumer confidence. Summing up, we raised the 3 key ECB interest rates by 75 basis points today and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period. This major step front-loads the transition from the prevailing highly accommodative level of policy rates towards levels that will support a timely return of inflation to our 2% medium-term target. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting
Clayton says he
approach.
sees an S&P 500 trade setting up. You're already late, bro. It's already made a lower low.
To ensure that inflation
But of course, it'll flip.
returns to our
Probably
medium-term
flip during the
inflation
press
target.
conference Q&A.
We are now ready to take your questions.
Here we go.
Thank you, Madame Lagarde.
Here comes the drums.
The first question goes to Luke Heighton of Market News International.
Good afternoon, President Lagarde. 2 questions, if I may.
Yeah,
First,
Maida, that's a
could
very
you give
an
us
American
a flavour
move.
of the governing
In some
council's
countries, that's
discussions,
insulting.
The arguments for and against that led to today's decision to raise rates by 75 basis points and not, for example, 50 or 100 basis points. And then my second question, from the present standpoint, how close to both the neutral rate of interest and the expected terminal rate does today's decision bring us, in your view? Thank you.
I'm surprised how casual
Thank you
everyone
very
is
much for
dressed,
these,
including
two
Lagarde.
questions. I'll take them in turn. On your first question, the Governing Council unanimously decided to raise the 3
Good morning, DK.
ECB rates by 75 basis points. We had different views around the table, a thorough discussion, but the outcome of our discussions was a unanimous decision. So how did we come to that decision? As I have said before,
The lake looks
and
pretty
as I have
this morning,
repeated
huh?
in that monetary policy statement, since our last July meeting, we are data dependent and operate meeting by meeting. This is the methodology that we adopt. So we were presented by staff with their projection. We had the inflation numbers and the growth outlook, of course. So in the face of these extremely high numbers, the last reading was 9.1 for a monthly reading. But if you look at the last 10 readings, they were the last 10 highest readings in turn. We had a good analysis of the decomposition of the sources of inflation, a good analysis of where the inflation actually lies and what products are particularly affected. And while we conclude, of course, that energy is still the major source of inflation, it's 38.3% compared with a year ago, slightly moving down in these August numbers. But it is still a dominant factor, as is the increase in food. But we also have an inflation that spreads across the whole range of products, in particular in the service sector, where supply factors are less prevalent and where demand plays a role. So we have a range of the product and services that are actually north of 4%. So in the face of an inflation that is extremely high, that is of a magnitude and persistence across sectors of that nature, obviously determined action had to be taken. And this is very much in line with our determination to actually normalize monetary policy as we started back in December. So for those who consistently repeat that the European Central Bank is lagging behind,
I don't listen to anybody.
We are on a journey.
I don't know who
back
Peter
in December, where we decided to put an end to the asset purchases under PEP and under APP, to move out of negative interest rates as we did back in July, and now to continue on our normalization path with a front-loading exercise that we conducted today, because we believe that the deviation from target is such that it warrants this front-loading. And we also decided that this was not an isolated decision, but that we would raise interest rates further. We didn't say that we would raise interest rates at 75% as if 75 was the norm. It is not. We will determine, meeting by meeting, on the basis of data, how we reach to that level of interest which will actually return us to the 2% target in the medium term. It is not there at the moment. Our forecast at the end of December, which is not the medium term, but the end of our projection,
I don't follow anybody.
is at 2.3. We are not there.
No disrespect to him. I don't know. I do all my own research, so I don't really.
But we had a very you were interested in the flavor of the Governing Council. We had a very cordial, effective, deep discussion on all these matters. And that's certainly.
I mean, I get some institutional reports from Morgan Stanley and Goldman Sachs that they provide clients, but other than that, it's just interesting reading.
This 75 basis points hike. Now, you asked me about how close we are to the rate. Whether you call it a neutral or terminal is obviously different, but I would like to say this. What I know today is that 0 is not the neutral rate, and that where we are is not the neutral rate. We are heading in that direction. It takes a front loading. It will take further hikes.
Typically, a neutral rate is 1.5 to 2%.
Of a magnitude and at a pace that will be determined meeting by meeting.
It should be based on GDP and not inflation, however.
But we are certainly heading there, because that's where we believe that we will actually deliver on our 2% medium-term target.
That's right, Pavel. You're right.
As indicated in our strategy.
Thank you, President. The next question goes to...
He's got a green tie today.
CNBC. Annette, please.
He usually wears a gray suit with a gray tie.
For taking my question. I have one on quantitative tightening, because clearly that could be also a way to drain liquidity from the system and help you to tame inflation. Have you discussed it? Is that something you are looking at? And then one question about your economic outlook, because clearly for 2023 you are seeing growth coming back to 0.9%, if I'm right, but this is still quite optimistic compared to other forecasts. So
it's 24.
24, yeah.
1.9.
Okay, but for next year, why don't you see a recession? Because many economists do see one. Thank you.
That's a good question, by the way.
Let me start with the second one. So the baseline outlook is 3.1 for 22, 1.9 for 23, and sorry, I'm getting confused as well now. So back, 3.1 for 22, 0.9 for 23, and 1.9 for 24. So that's the baseline that we have in the projection by staff. We also have, and I think you will be receiving those documents as
Frank,
well.
I
We
trade
also have a
technicals
downside scenario
and
that has been
fundamentals.
produced
Do
by
I
staff
trade
on the
speeches?
basis of
No,
assumptions,
but if
of
something
risks in
comes of
particular,
this
some of which
speech,
have already
then
materialized.
yes, but not the
And
speech
in those
itself.
numbers, you will see that from memory, growth outlook is at 2.9 for
So I will be
22
updating the
is
models
at
based on the new interest rates
0.9
in Europe.
for 23 and at 1.9 again
And it could
for
be a
24.
turning point
So
for Euro. It could be.
while even in our baseline,
But
we
I'm not going
foresee
to
some
scalp the vol.
stagnation for the last quarter of 22 and the first quarter of 23.
You could, of course.
In
You
the
could.
baseline,
Totally,
we
you
don't
could.
forecast
But I'm a macroeconomic trend trader.
negative growth in
So I'll see it
23.
in the
the
data.
downside scenario, we do. That downside scenario differs from the current situation in that it includes in
Right now, I
particular
see the S&P 500 coming
total
down, and that's
shutdown
risk
of
off.
all
And I'm already
Russian
in
gas
that play.
supply. Well, we're almost there. There's still a bit of flow going through the Ukrainian ones. But we also foresee rationing across the whole euro area.
Moses, you
and
just
no
Google it.
measure
You
of
get a full
compensation
transcript.
between the shortage of gas supply and other alternative sources of supply. So nothing coming from, either Asia or other producers of gas. And in particular, I don't think we take into account the LNG that we could be sourcing from more of it from Norway, from the United States. So it's
All right,
really
she just
dark
answered the
downside
question,
scenario, but it's one that
Majib,
contributes to a 23,
and that's going to happen in late October.
recession. But it's the downside
That's the
scenario,
answer.
it's
That's
not the
why.
baseline.
When you look at the arbitrage and the law of one price,
So on the
we'll move closer to a lower European
on the
price and a
issue of,
higher American price.
quantitative tightening,
And that's going to happen in late October,
what we are focused on
maybe
at
early
present
November.
is the most effective and most proportionate and most appropriate monetary policy instrument that we can use. And we believe at the moment that it is the policy rate. So we are using the policy rate. We will continue using that policy rate in the next several meetings, as I have said. And of course, we will look at other monetary policy instruments. But at this point in time, it is still premature. But it is a matter that we will, of course, debate amongst members of the Governing Council in due course.
Thanks, Team Sound Zone. Powell's on stage now, guys. Get ready for the crosswinds. See, the ECB raises by 75 basis points. Powell will come out and say they're going to raise by 75 basis points,
I have two questions as well.
which means the ECB didn't do anything,
One, I
relatively
want to ask
speaking.
You about inflation and interest rates. You've said inflation is far too high. Decisive action is needed. Do you expect, from today's perspective, and I appreciate it's a difficult thing to say, that the ECB will have to go into restrictive monetary policy to get a handle on inflation? And the second one relates to your mention of government deposits and how they are remunerated. The cap on government deposits has, along with collateral scarcity and high excess liquidity, led to a considerable divergence of short-term rates in markets. And I am curious what you decided on that, and how do you see the policy transmission improving as a result of your decisions? Thank you.
To your first question, I think it's a process of normalization that we have started. As I said, beginning in December, out of negative territory in July.
What she's
moving
saying
with
is she's
this
not addressing
front-loading,
inflation.
Step in our journey of normalization.
She said it
towards,
over and over and
such
over and
rates
over
that can
again.
be compatible,
She's just trying to
for
get
us
rates
to
back to a
deliver
neutral zone.
and ensure
A neutral
return
rate,
to our 2%
not a terminal
medium-term
rate.
target. So for the moment, we normalize. Once we have reached that level of normalization,
See,
that
normalization.
will enable us to have the confidence that we will return to the target of 2% in the medium term. Then we will examine what is the situation on the basis of data.
She already did
on the
that,
basis
Richard.
of what monetary policy can
About
contribute
4 minutes
to
ago.
the economy. So it's We will cross that bridge when we cross that bridge. For the moment, we are actively busy and engaged in normalizing our monetary policy and in making sure that we actually return to our 2% target. On the other matter that you raised, you will be getting a technical press release that will describe precisely what decision we made in relation to the remuneration of government deposit. My recollection is that we're moving from 0 to DFR, but I don't want to sort of jumpstart, and I will let you just consult with great interest the technical decision that is embedded in the press
S&P
release.
still risk off.
Thank you, President. Next question goes to Aude Kersulek of BFM TV. Aude, please.
Thank you. Mrs. Lagarde, you told us that the depreciation of the euro has been a criteria to this hike today. Does the ECB have an objective of on the euro exchange rate, since this would appear a way to lower the imports, to the cost of imports, especially energy ones? And second question about the TPI, you unveiled details in the last meeting, but nothing has appeared in the official journal. Can the TPI be used from now? And if not, why take time to implement it? Is there any question about who bear the financial risk of these operations? Thank you.
Thank you very much for your two questions. It will not surprise you if I say that, of course, we do not target any kind of exchange rate for the euro, but of course we monitor very carefully, and just like all of you, we have noted the depreciation of the euro relative to a basket of currencies, but more importantly, relative to the dollar. Just to give you a magnitude, an order of magnitude, it's over the last year 12% relative to the dollar and 4% as nominal effective terms relative to other currencies in general. So, of course, we notice. We know that it does have an impact on inflation with a lagging time about it. It has direct and indirect effect as well, and we are very attentive to those. But we do not target an exchange
Just
rate,
beautiful.
and we have not done so and will not do so. On your other question on
Just
TPI.
beautiful. What an amazing day.
You know, I don't have much more to say on TPI than I did last time around in July. And I don't think that you should expect much more. I know that some would like to have masses of information on TPI. TPI has been debated at length, approved unanimously, has some criteria and some eligibility dimensions to them, has termination point too, and if and when the criteria are met and the eligibility conditions were satisfied, we stand ready to use TPI. No question about it.
Thank you, President Lagarde. Turning now to WebEx, I see
Why would you say that?
Balazs of Reuters has his hand raised.
Why would you say that line?
Next question is for you.
Good afternoon, and thank you very much for taking my questions. First question relates to telcos. Madam President, banks that have borrowed telco money on the cheap now stand to benefit by depositing this with the ECB. And that sounds like gaming the system to me, but I know some of your colleagues are uneasy about the prospect of this. Did you discuss today changes in telco conditions, and is this something...
So I have a target on this USD yen, 200 pips above us, and that would get me 1,000 pips. Buy it at 36, exit at 46.
Some of these
nice.
Downside risks have materialized.
Killing me softly with your trades. Killing me softly.
To reconsider the policy rate path and say, now this recession is actually deflationary and we need to stop rate hikes. Is the downside scenario enough for this, or would you need an even deeper recession?
So on your first question, I remind you that the TLTRO changes of conditions that were introduced during the pandemic were engineered, designed, and intended to encourage banks to lend to the economy, which is what we all wanted, which is what was predominantly done.
Feels like a
And the
time for a flip,
TLTRO
though, huh?
pricing that was
Flip,
then
flip time?
designed was intended to that effect. Now, it's obvious that as we are shifting to positive territory in terms of interest rates, there are multiple dimensions of our operational frameworks, our remuneration mechanisms that need to be revisited. And this is a matter that we will take up, that will see some resolution. It has not been debated on the occasion of this particular monetary policy meeting, but it's an overall review that we
ECB are
will
master
obviously
debaters.
conduct in due course. On your second question, look, we are in a situation where
Here
at
comes the drums.
zero interest rate, and even with this front-loading, we are stimulating the economy with an expansionary monetary policy. Now, doing that when we have 9.1% inflation and projected inflation at the end of our projection period north of our target at 2.3 simply does not warrant that accommodative monetary policy continue.
Normalization means
our mission
not
is
higher
to
than usual
restore
interest
price
rates,
stability,
because
is
that's
to
what
return
would
inflation back to 2%.
address high inflation.
As a result
What
of
she's
that, we
saying
are
is they
determined
can't keep
to do
interest
this
rates
job,
at zero,
and we will continue
which is
to
accommodative.
make the
So
decisions
she's just removing
on the
accommodation.
basis of data,
So what I read
meeting
is
by
she'll
meeting,
raise interest
and
rates to,
obviously,
let's say,
if we
I don't know,
are
I'll
faced
throw out
with
a number,
major
2.5,
supply shock, if, for instance,
and then
gas
she'll stop.
prices were to continue to
She's going to
skyrocket,
neutral, not
well,
terminal.
we will take
The
that
terminal
into
rate
account,
for
both
her
in
is
terms
the
of
neutral rate, is what
the
she's saying.
consequences on growth, which will be recessionary, but also consequences on inflation. And that work will be done in due course, as I said, meeting by meeting. Thank you.
Thank you, President. Next question is for Martin Arnold of the Financial Times. Martin, please.
Thank you very much. Could I ask a question about the terminal rate? Have you identified
There you go.
the terminal rate? Can you share that with us now? And could you also talk about whether the
See, he's
incremental
like,
interest
you
rate
haven't said anything
rises
about a
get
terminal rate.
smaller as you get closer to the expected terminal rate?
Here we go.
Thank you.
What I can tell you for sure is that as we are so far away from
See,
the
there's no terminal rate.
will help us return inflation to 2%, our hikes have to be not only timely, but of a magnitude that brings us closer and more quickly towards those rates. Now, a contrario, am I saying here that as we get closer to those rates, the incremental interest rates increases will be smaller? No, I'm not saying that, because we will proceed meeting by meeting and on the basis of data. So I don't want to prejudge and to anticipate.
She's skirting the
What I can
question
tell you is
because
that
what's
the
happening
further away we are,
is that they've only decided to raise interest rates
the
to,
larger
above zero.
the step we are taking, which is why we are front-loading.
They just
now.
need to get to a normal level of interest rates.
Do I know exactly what is the terminal rate? No. And this is a matter that
So
is
they haven't
going
even,
to
they're not even
probably
talking about a
agitate
terminal rate. They're
debates,
just
and
saying, you know
everybody
what?
will have their
We
view,
can't be at zero.
but it's
We just can't
obviously
be at
one
zero.
that
We have to
decide
get rid of
again
accommodation
as we get closer,
and raise
and as
interest
our
rates to at least a
forecasts
normal
tell
level.
us whether or not we are
And what
reaching our
what that
goal,
is
the
debatable,
2%
but they're not talking
medium-term
about raising
target
interest rates to
inflation.
6%. They haven't even
This
talked
is what
about it.
on every
That's what
occasion
she's
will
saying.
help us define or not whether we are at that
She's like, terminal rate?
particular rate.
We'll talk about that when we get to a neutral rate.
Thank you, President Lagarde. The next question
And again,
is
that's
for
got to be
Jan
about
Manin
2%.
of Handelsblatt. Jan, please.
Good afternoon, Madame Lagarde. I have one additional question on quantitative.
What do you think? Should he shave his head?
Would it be possible for the ECB to end its reinvestments in the APP program in the near future? Because, the Bank of England, the Fed, have initiated QT already for some time. And my second question is on the forecasts. The ECB has underestimated inflation for some time. So how relevant are they still for monetary policy? Thank you.
Well, thank you very much.
Well, the XL, she can't
You
say that
remember
either.
that
She can't.
last July,
She can't
we
raise interest
decided,
rates to 6% and
to,
kill the Greek and Italian
no
and
longer
Portuguese
rely
economy.
on forward guidance on
But she
many
can't say that
aspects,
either.
and to work meeting by meeting on the basis of data, with the exception of the reinvestment program.
Oh, you think,
APP
Lucas? I
and
thought he
PEP,
looked like the King of
for
England.
which we still have some forward guidance. So the forward guidance that we have on APP is that maturing securities which were purchased under APP will continue to be reinvested as long as is appropriate in order to maintain ample liquidity conditions and an appropriate monetary policy stance. For PEP, it's not exactly the same forward guidance, but we also have forward guidance, and we refer to at least the end of 24 without interfering with our monetary policy stance.
You watch the
Having said
XLs,
that,
that's going to change at the end of
what we
October.
are doing now is
Very, very
focusing
significantly
and
down.
giving priority to the policy rate, because we believe that it is the most appropriate, most proportionate, most efficient instrument that we can use in order to return inflation to the 2% medium-term target. We, of course, examine all instruments, and the reinvestment policies that we deploy is part of the instrument. But now is not the time, and we would regard it as premature if it was to begin now. We are using the policy rate. It will happen. But on the basis of data, on the basis of our analysis meeting by meeting, and once we have determined that these policies of reinvestment,
That's a beautiful suit, though, isn't it? I mean, it's beautifully tailored. She's got class, I'm telling you.
Help us return to the 2% medium-term target. You had a second question, if I recall.
Underestimation of inflation.
Oh, yeah. Yeah. Look, this is
Thank
a
you,
matter
the
which has
XLs.
been raised by
I'm just
many.
talking about market mechanics.
Can we trust forecast? Can we trust the provisions? Can we work on the basis of numbers that are produced by our economists?
By the way, I've covered it in
And
great
we were
detail
as
in our
blunt
oil
as to
and
actually
energy trading
examine
course.
why and where the errors came from. Because yes, we made forecasting errors, as did all the international institutions, as did most
No,
of the
Mato,
economists,
because we get that from the
because
Commitment
it's
of Traders
virtually
report.
impossible to actually anticipate and include in your models
That's updated on the
COVID,
weekends.
the war in Ukraine, the energy
Because you just can't
pipeline.
get that information.
So yes, we made those errors, and when you go under the surface and try to find what is the origin of those errors, it's predominantly related to energy. So while I take the blame.
And just a
because
heads up,
I'm the
Maida,
head of
on
the
the weekend we'll get information
and yes, we
from
made
Tuesday.
forecasting errors.
Well, now it's
But those
Thursday,
errors
so
were
we
made
still
by
won't have that
all
on the weekend.
Forecasters, we are not very different from them. We accepted we made errors. We came forward with the causes for the errors, and I can assure you that staff constantly improves, tries to embed in the models what should be embedded, which was not up until now, and that we also apply as much judgment as possible to be as accurate as we can.
Okay, we're
But
at
it is
about a
fact
382, approaching a
because these
50%.
matters could not be anticipated,
Should get interesting
we
between
have
here and
had
the
to
618.
revise our projections. Absolutely.
Thank you. Thank you, President Lagarde. Next question is for Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you. Good afternoon. Thank you very much for the opportunity. So I have two questions. One on financing conditions. As you said, they are getting less favorable for households and firms. is the tightening in the credit and bond markets going
Richard, I
too
do
far?
have stuff like that,
And
but
I link
I
this, my
can't.
second question, to
No,
financing
the answer is I can't
conditions
gather it, and it would
and
be
the
incomplete.
terminal rate, because the terminal rate is becoming a sort of forward guidance for us. And so if you say that we are so far away, then the market is going to have to price in the next interest rate hike, and tightening conditions are going to get, yeah, tighter and tighter. Thank you.
Thank you very much for your questions, but we actually took the decision today that we would continue to raise interest rates. It's not just front-loading and then we are done with it. We are front-loading and we will continue to increase rates, meeting by meeting, on the basis of data, because we believe that we are far away from the rate at which we hope and will see inflation return to the 2% medium-term target. This is the goal that we have. You know, I'm not sort of scratching my head around the neutral rate versus the terminal rate versus the R star and so on and so forth. What we know is that we want to get to that 2% medium-term target. And we will take the necessary
R star,
steps
though,
along the way
that's a
in order to get
classic
there.
economic model
It will
that
take
she's
several
talking about.
meetings. Some people will say,
It's
how
kind of
many
cool
is
that she
several?
dropped that.
Well, it's probably more than 2, including this one, but it's probably also going to be less than 5. Now, I leave it to you to decide whether it's going to be 2, 3, or 4. You have at least a
little bit of
ballpark
red,
idea of
well,
how
in
long
this
it
case,
will take.
black. A
That's
little bit
the
of black
length
on the
of the
candle,
journey.
right on the,
And
right
this is
on.
the reference that
Well,
we
right
make
when I
to
said get ready.
timely. You know, we want to
Interesting.
return
We'll see.
timely
We'll see if it'll
to
extend
that,
down. Doesn't have
goal
to.
that we have. Now, you've asked me if the tightening in the bond market is going too far or not. It's not a bad anticipation that they've done, I would say. I'm not sure it's perfectly accurate, but it's not a bad market assumption.
Thank you.
That was cool.
In current conditions.
Next question goes to Eva Wissing of the Dutch
Cool.
broadcaster NOS.
Thank you for taking my question. In the Netherlands, we experience one of the highest inflation within the Eurozone. For years, the ECB has been trying to bring up low inflation. What makes you so confident that you can now really bring back down high inflation? What perspective can you give to our citizens?
Well, look, first of all, the Netherlands is in the region of the high inflation.
Richard, are you talking about the nat gas price?
And higher interest rates, particularly up north and in the Baltic countries. So we are very aware of the heterogeneity that we have between, say, Malta and France and the Netherlands and Latvia, for instance. And we have to care about all citizens of the euro area.
Yes, Lucas, of course.
I think for many years, what my predecessors have tried to do is to make sure that we didn't go into deflation territory. And that is the reason why, you know, there was negative rate, there was quantitative easing used ever since 2014. The situation has significantly changed in the last 12 months. And, you know,
The candle's looking good, huh?
I'm not trying to make a fine point or be cute about it, but we haven't tried for years to reduce inflation. Inflation is a phenomenon that we are facing and have been facing for the last 12 months or so. So
Let's see if it makes a lower low on the fiver.
On that path of normalization of monetary policy. So we are exiting that period of quantitative easing and negative rates. That is behind us. We are now moving into positive territory at a front-loaded pace, and we are determined to return to the 2% medium-term target that we have under our strategy review and as a common denominator within the Governing Council. And we will take the steps that are needed to that effect.
Will get to bring inflation down than to bring it up?
Future will tell. But what I can assure you is that we are determined to do so. Inflation is a terrible phenomenon, in particular for the less privileged people. I think we are all aware of that. Our job is to
I
return
love it when rich
inflation
people
to
talk about
2%,
poor people, huh?
and we will deliver on that job. We should not expect, and nobody should expect, that inflation is going to return to 2% in the next 3 months. Why? Because there
Did she
is
think about
a
poor
lag
people when she
time
was
between
getting
the
that suit
time when
tailored?
we make the decisions and when it actually translates through the transmission channel to the real economy, so to speak. And also
Like, that's a
because it is still
$5,000 suit. That's probably
predominantly
a
a
$500
supply-driven
scarf.
phenomenon. I cannot reduce the price of energy. I cannot convince the big player of this world to reduce gas prices. I cannot reform the electricity market. And I'm very pleased to see that the Commission,
I watched
the European
a
Commission, is
2-hour
considering steps to
video
that
at
effect. Because
Harvard
monetary
about
policy
poor
is not
people,
going to reduce
and I
the
just
price
thought
of
it was the
energy.
funniest thing
It will
ever.
contribute to reducing expectations. It
And the
will
professor didn't even
give
get
a
it.
strong
When I
signal
brought
to
it up to
people
her,
that
I
we
said,
are
you know,
serious and that we will
it was
contribute
pretty funny.
to reducing inflation.
And she didn't get it. She
But
just
if
didn't
the
get it.
cause is predominantly surplus driven and based on energy prices that keep rocketing, this is for somebody else to do the job. But we will do ours. We will do our job.
And the next question goes to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Thanks a lot. Good afternoon, Madame la Présidente. On interest rates,
Oh,
is
this
the
is
ECB
interesting.
ready to
It's
raise
trying.
the rates above
It's trying
the
to go
terminal
up.
rate
We got it
if
trapped
it is necessary to bring back
on a
inflation
5-minute bar.
to 2% to force it, because and then bring it back to the terminal rate, what level it is. So this is maybe my question on guidance, if you can give us. And you said this.
Look at him. At least he's got a suit jacket on, but no tie. I'm just amazed by that.
ECB and other made errors. So is in monetary policy now for this period something has more to do with artistic than arts than with science? You outlined this in a previous speech. So what is artistic in the decisions made today? Thank you.
Merci. As I said earlier, we start from zero. We're taking a major step by front-loading, and we know that we have more steps to go towards that that rate at which we believe that.
Yeah, she's got moves like Jagger. Hey, Richard.
In the medium term. If it means that we have to go further than whatever rate you refer to,
Trichet was like that
we
too.
will do so. Okay? Because we have a goal, we have a mission, we have incredibly high inflation numbers, we are not on target in our forecast, and we have to take action. We don't want to see second round effect. We want all economic actors to understand that the ECB is serious about returning inflation back to 2% in whatever decisions they make. Now, you asked me about the artistic side. I wish it was artistic. What I meant is that, and I think I was quoting another famous, not that I'm famous, but a famous central banker who said that it was not just about science, but there was also an element of art about it. I think what I understand that to be is that we cannot be purely mathematical. We cannot be exclusively driven by the outcome of models, however sophisticated they are, however judgment we put into the selection of assumptions that we make. We also have to include in those decisions that element of collective
top to
judgment
bottom in the
that we
trap.
try to bring to the table in the course of those discussions. So that's what I meant.
Thank you, President Lagarde. Turning back to WebEx, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Hi, thanks so much for taking my question, President Lagarde. So yeah, I had two questions. As you've been speaking, the euro has been falling, and I suppose my question revolves around the likelihood of another three-quarter interest rate hike at the upcoming meetings. You've said that's not the norm, but will
Upside breakout.
forward?
Upside
And
breakout.
my second
Uh
question
oh.
was on the contrast between what's happening in the US economy and what's happening in the Eurozone. You've previously emphasized that the Eurozone is in a different place from the US. The Eurozone inflation rate is now above the US level. Does that mean actually that they're in a kind of quite a similar situation when it comes to inflation, and the medicine needed is similar? Thank you.
Thank you very much. On your first question, what I'm saying is that we are not on a set course other than be driven by our goal. So our decisions will be made meeting by meetings, will be data dependent, be state dependent. And
the next line is 99.99, really.
we're not
99.90.
trying to mimic any other central bank.
99.85.
We are not transforming
Are we going all the way back to parity?
Exercise into a permanent exercise. But if
could
the
be
data
a rabbit, could be.
On our meeting by meeting
I want to jump a little bit.
review suggests that we should take a high hike of our interest rates, we will do so.
Yep.
So it is not preset, it is not predetermined, and it will be decided on a meeting by meeting. But the certainty is that we are far away from the goal. We are taking a major step today by front-loading, and we will decide more interest rate hikes in the future over the next several meetings. Your second question.
Contrast Eurozone, US.
Oh. I think you know the answer to the question, but I'm happy to repeat it. If you compare the situation of the US and that of Europe, and in particular in relation to inflation, inflation in the United States is largely driven by demand. In the euro area, it is largely driven by supply. Not exclusively, there's also a portion of demand in the sources of inflation, but it's predominantly supply. When you look at the labor market, which is an important phenomenon to appreciate whether we have a risk of further escalation of inflation and second round effect in particular, we see a US market which is, some of you say it actually, red hot, where the rate of vacancy to unemployed person is
how you say in English,
whereas here,
smoking hot like fire.
Large, it's 0.3 to 1. So for one vacancy, we have 3 unemployed people. It's a slightly different situation. Third difference is that clearly in their normalization path and possibly tightening path, the Fed is starting from a different base from that of the euro. We were starting from negative territory, moving out of it, and going further on that normalization path. I think there are multiple other differences that I could give you, but I think those are the ones that will matter most for your analysis of the difference in inflation situation that we have.
Thank you, President Lagarde. And the last question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Madame Lagarde. In December, you were saying it was unlikely that rates will hike this year. In June, you were saying that in July it will increase by 25 basis points and it went up by 50 basis points. Now you need to front load now. Obviously, as you said earlier, you couldn't forecast the war in Ukraine. You couldn't forecast the gas embargo that's happening. But nevertheless, are you worried about the credibility of the ECB? Because every time you need to basically accelerate. And the second question, if I can come back on the exchange rate, obviously you've said it several times, you are not targeting a level, but can you elaborate on the effect that the exchange rate has on the current economic climate here in the Eurozone?
Thank you very much for your question. Good piece in Le Monde this morning, by the way. On the need to accelerate, what I can tell you is that at this point in time, with the numbers that we have, with the dynamics that we see, with the sources of inflation, with the forecast that we have, we are determined to move, and to move at this timely pace that is referred to in the monetary policy statement, which means that as we are deviating from target and with the high numbers that we have currently, we need to front load as we have this time around, and we need to continue hiking. That's our determination. Yes, we had to accelerate because when you are faced with new data, with new analysis, with new forecast, you of course have to adjust. And I think that our credibility will be judged by whether or not we return inflation to the 2% medium-term target as we are committed to. On the second one of the impact of the depreciation of the euro in effective term and relative to the dollar, I don't have a decomposition right now of how much exactly it contributes
Barry,
to
it's
the
a
inflation as
Cohiba
it
Black.
stands, but it will be available in the documentation that will be published later on. Suffice to say that indeed it has a direct impact on our imports in particular, to the extent that most of the energy products are issued and denominated in US dollars.
Thank you, President Lagarde. This brings our press conference to an end. Thank you very much, everybody, for following. The next scheduled press conference is on the 27th of October. Up until then, I wish you all the best. Good afternoon. Bye-bye.
Cool. Hey, that was neat. That was neat. It flipped right on our flip zone. Now we're back at the retest zone. Very cool. There's no forward guidance. There's no terminal rate. They're simply raising interest rates back towards the neutral zone. They're going to keep raising interest rates. And that's it. And they don't want to seem sort of behind the Fed. And they're addressing some euro weakness in there as well. Their main concern, of course, is inflation due to energy prices.
Good afternoon and welcome to our press conference. It's very good to see many of you here in the room again, and also obviously very welcome to those who join us remotely. We are here on stage with President Lagarde and Vice President Beginners.
Where did it go?
My name is
Wolfgang
Wolfgang
I gotta kill
Preußen.
it here. Hang on.
Later in the question and answer session, I would like to ask you to identify yourself and if...
All right. So they're worried about energy prices and in particular natural gas. Remember when they say gas, Americans, when they say gas, they don't mean gasoline. Right? So natural gas prices are what's driving up a lot of their inflation, and they know that. And they believe in a year or two it will normalize. I believe in somewhere between 6 and 12 weeks, right? Approximately the end of October, maybe early November. Natural gas prices are going to plummet in Europe and skyrocket in the United States of America. If you want to know why, you should join our oil trading course. And I think what I want to do with the oil trading course, we're done with the normal levels, the normal lectures. I think we did 10 lectures. And I was thinking about doing kind of like a watch party where we get people to go through all the courses again as we move into the second part of the course, which is focused on technical analysis and trade setups and practicing in the live market. So I think it'd be an interesting thing to do to get people to go through. I think people need to watch the oil lecture course. I think if you are interested in the markets in general, but in particular trading oil, that those 10 lectures, which have got to be close to 15 or probably more like 17 hours of lectures on the energy complex. And so why would it be important? Well, when you're listening to the ECB talk about high energy prices and it's driving their policy, they're economists, they're not traders. They don't necessarily understand the mechanics of the market and why I would say that there's an arbitrage coming up in 8 weeks and that will probably drop energy prices in Europe. And you're like, well, Wayne, how do you get to that conclusion? Well, you lack some information. Now, of course, I could be wrong, but I have a reason why I have that opinion. I'm not making it up, and it's not fundamental economic data that an economist would look at. All they see is high prices, and they believe the supply chain at some point will normalize, that the war in the Ukraine will come to an end, and that they would renegotiate contracts, and this won't last forever is basically the idea. But you kind of need to know how the market works. So they don't see this coming. And again, I could be wrong, but I know why I think what I think. And that would be a reason why you would want to know how to trade. Not just the technicals, not just the fundamentals, but even the mechanics of the market. So anyways, look for an email from me. I'm not sure how I'm going to do it yet, but it's my idea where I'd like to do sort of a big regrouping, almost like a conference, right? It's like a 15-hour conference. So maybe we'll do something, maybe next weekend I'll do a kind of like some sort of special event, some sort of way for you to come in and watch the videos and get prepared for the next half, which is I think one lecture on technical analysis and when to trade, how to trade, all that kind of stuff. And then we go into a couple of weeks of daily live, essentially scalping or day trading of WTI. And Brent, of course, but really focused around WTI. How cool is that? Good idea? Of course it's a good idea. Yeah. So anyways, I wish you the best of luck and the happiest of days. May the pips be with you. May your profits be above average. And for those in my swing trading group, we will be meeting today at 4 p.m. for our weekly love. So, peace on earth. May the pips be with you. May your profits be above average. Thanks for hanging with me. I'll see you later. I'll see you when I see you. And, yeah, I guess I just hit this.